Hey, great. How you doing, Mr. Garnett Cook? Hope you're having a good Memorial Day weekend, heading into the last full week in May. Um, I'm going to be doing a screencast today on this coming week's focus, which is the stock market crash of 1929 and the Great Depression. Most of what I'm going to talk about in this screencast is focused on the United States experience during that period. We'll come back to Germany a little at the end of this screencast, and then certainly a lot more next week as we talk about the rise to power of the Nazis and the expansion of German power in the 1930s, leading up to what will become the Second World War. So our focus today is the stock market crash of 1929 and the first, really 5-6 years of the Great Depression. And we're going to be focusing today on what happened, give you as simple an explanation that I can offer. One of the challenges of learning about the Great Depression is that even now, 80, 90 years later, you could line up 10 economists and get 10 different explanations for what caused the Great Depression and why it got worse and worse and worse. Different people have different ideas about what the big issues were. I'll try to hit on in this screencast what are some of the generally agreed upon factors that caused the market to crash and caused the Great Depression to get worse and worse and worse between 1929 and say 1933, 1934. I want to start with the stock market crash. You're going to be learning a little bit this week on your own about the crash of the stock market. And what I want to do is give you as simple an explanation of and a history of the rise of the stock market in the United States as I can in as short amount of time as I can give it to you. So this is an image of what is known as the New York Stock Exchange, which is located in Lower Manhattan. It's right near Federal Hall, where there's a big statue of George Washington. If you've ever been down in Lower Manhattan, you may have been by the building where the stock exchange was housed. Nowadays, a lot of stock trading is done online. And so the stock exchange does not work quite the same way it used to. But back in the old days, there were stocks being physically traded back and forth every day, really, for a long, long time, until actually not all that long ago in American history. Quick explanation of what we mean when we talk about stocks. So, in a nutshell, a stock is a certificate that represents a share of ownership in a company. So the way it works is, if you have a business of your own, in order to operate that business, you need to raise money. You can raise money from your friends. You can raise money from banks. Typically, people will go to banks and get business loans, and they'll start a business. Well, if a business gets big enough, and if a company really wants to expand and become, a sort of bigger business, a national business, maybe even a global business, at a certain point, you need to raise money from different sources. And so what companies will do when they reach a certain level of growth is they will take a portion of ownership in that business and they will essentially make it public. And what that means is that a certain share of ownership in that is going to be sold to the public in the form of what is called stock. It's essentially something that represents a small share of ownership. If you purchase stock in a company, it means you own a tiny percentage of that company. You're an investor in that company. And a stock market, very simply put, is where stocks are bought and sold. All right. It's a great way for businesses to raise a lot of money. It's also, if done right, a way for people like you, me, anybody else, to be able to earn some money that can grow over time, if you're a good investor, that is, anyway. And that's where you get some of the story of what happened in 1929. There are some people who made very risky and ultimately careless investments. This little diagram that you see here in the middle of the screen, it's a simple stock market diagram. And it gives you a general explanation of how stock buying and selling works. So on each side of a stock sale, you have what are known as buyers or investors. And then you have the sellers, the people who are selling stock. And then there are these people in the middle called brokers who basically negotiate the buying and selling of stocks for you. They're sort of the go-between. And the stock exchanges are where that activity typically happens. Then you have these things called indexes that measure the rise and the fall in the stock market. So if you've ever followed, you ever watched CNBC or any of those financial shows, they'll always have what is known as the Dow Jones Industrial Average or the NASDAQ. Those are indexes that show you how prices in different companies are going up and down, day to day, and then over the course of time. By the 1920s, the stock market in the United States was becoming very, very hot. In other words, there were a lot more companies that were being what is called publicly traded, and there were a lot more people who were beginning to invest in stock. This is a cool little image I found. It sort of shows you the history of different areas of our economy and how they have factored into the stock exchange over time. So you can see like finance over here. This is banks and investment firms, and they've always been a huge part of what has been publicly traded on the stock exchange. You could see in the middle of the 19th century what are known as transports, where transport companies were being bought and sold on the stock exchange. That's like railroads. This is when the railroad industry really took off. You can see in this green here, this is energy companies that were being traded on the stock exchange. That's when oil became big, and then electric power came in. And you can see sort of how different sectors of our economy and the companies that are a part of them, their importance in the stock exchange over time has grown. You can see it was really the late 19th century and into the early 20th century where we see all these different parts of our economy, companies in which are being bought and sold in the form of stock. And so by the 1920s, and here's the 1920s, you have a lot of activity going on in the New York Stock Exchange. Lots of people are getting involved. And what happens in 1929 is the stock market crashes. Now, markets can go up and down. And basically, and I'll explain this graph here in a second, but very simply put, if you're going to buy stock, the idea, generally speaking, is that you buy a stock when the price for a share in that stock is low. And if you're going to sell, you want to wait until the value goes up before you sell. So if a company is doing really well and is making a profit and their business is growing, then the price of their stocks are going to go up over time. And if you are lucky enough, you can get in and have a share of ownership in that company at the sort of low part of its growth. And if it starts to grow while you own stock in that company, you'll see the value of your stock start to rise. And that's what hopefully good investment is all about. But every once in a while, there is a point that is reached where the value of stocks outpace how strong the economy actually is. So for instance, you could own stock in an automobile company that is where the stock price is here, but the company itself is not doing as good a business anymore. And so you have this difference between how well the company is actually doing and how high the price of stock in that company is. When that happens, you will often see a rush of people who want to sell their stock because they'll start to recognize that their prices are way beyond what the company is actually doing. When that happens a lot, you can have steep dives in the stock market. If it really happens a lot, you can have what is called a crash in the stock market. There have been several crashes over time where stock prices have really gone down very rapidly in a very short period of time. The crash of 1929 is the most famous, all right? And you can see the crash represented on this graph here. Stock prices went up, 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 and then a sudden drop in 1929. That is when the crash actually happened. There are three generally accepted explanations for why the stock market crashed in 1929. One was the 1920s was a period of incredible economic expansion in this country. And there was a kind of collective belief in America that we were in a period of what they called at the time permanent prosperity, that the economy was just going to keep getting better and better and better and better and better. And so people were purchasing stock based on that belief. Remember last week I told you, a lot of our economic decision making is emotionally driven. And the purchase of stock was a great example of that in the 1920s. People were buying stock based on essentially the faith that the value of stock was going to continue to rise. Well, when the bottom fell out in 1929, people who had made those kind of investments saw their price of their stocks that they owned just dropped right off, and they lost a lot of money in the form of stock. So a lot of people have made risky and sometimes reckless investments in stock, spending, lending money, and that really came back to bite them in 1929. There was also this growing gap between perception and reality. By 1929 in America, there was a perception that the economy was going to keep getting better and better and better. that was becoming increasingly disconnected from the reality of the economy. Because by 1929, there were signs that the economy was slowing down. Automobile sales were dropping. The farming industry in the Midwest had taken a huge hit in the mid 1920s from a combination of factors. The farmers were losing money hand over fist by the late 1920s. Companies were beginning to lay off workers around the country. So there were these rumblings that the economy was starting to slow down by the end of the 1920s, and yet people just kept buying stock and buying stock and buying stock. Well, at a certain point, there's going to be a collective recognition that the value of stock is way, way, way out of line with how the economy is actually doing. And so people started to sell. And as some people started to sell, others began to panic and they wanted to sell. And then it became like a snowball in the fall of 1929. And so when stock prices started to drop, people panicked and tried to sell off all at once. And that is a recipe for a market crash. And that's what happened in 1929. Here are a couple of graphs to show you sort of what happens. This is a close-up of what is known as the Dow Jones Industrial Average. This is the measurement of essentially how stock prices are doing, generally speaking, in this country. You can see they peak in 1929, and then there's a major drop-off going into the early 1930s. You can see here in this graph the U.S. unemployment rate. And how the unemployment rate after the market crash started to really go up. So you can see it's just under 10% in 1930. By 1932, it's climbed over 20%. It peaks in 1933 at nearly 25%. So the economy really, really takes an enormous hit in the early 1930s. We'll come back to that a little bit more in a second. You start to see people lose their homes. You start to see unemployment go way up. People can no longer afford to pay mortgages on their homes. They can no longer afford to pay rent. And people are losing their homes all across the country. And they're forced to essentially find shelter wherever they can find it in sort of makeshift hovels like the ones you see here on this slide. The Great Depression is not something that happened automatically. One of the mistakes that people make is they think the stock market crash caused the Great Depression. The stock market crash did not cause the Great Depression. Well, I always like this, when I used to teach a stock market crash in class, I would say, look, the stock market crash was to the American economy what a runny nose is to a cold. In other words, it's a symptom. The stock market crash was a symptom of an economy that was getting worse. And so it just was this visible, clear piece of evidence. That did not necessarily cause the Great Depression. The Great Depression is something that unfolds over the course of time. The guy you see pictured here is Herbert Hoover. He was president at the time of the stock market crash, and he unfortunately is going to take a lot of the blame for the economy getting worse and worse and worse between 1930 and 1933. And just to give you an explanation of why that happens. So the economy is something that slowly gets worse. In 1930, over 1,300 banks failed in the United States. Later this week, I'll do a whole separate screencast on banks and how they can fail. I'll give you a little bit more of an explanation of that. The unemployment rate rose to 8.7%. In 1931, you have over 2,000 bank failures in the United States. Unemployment rises to 15%. 1933, when Hoover leaves office, you have over 4,000 banks failing in the United States and unemployment approaching 25%. So this is an economy that gets worse and worse and worse. And the claim was that there was an inadequate response from the federal government, that as the economy got worse and worse and worse, that the government just did not do enough to try to mitigate the effects of the economy getting worse. Now, there's some truth to that, but there's also the misperception that Hoover just sat by and did nothing, which is not true. I'm not going to get too much into the things that were done. It was not enough to turn the economy around. Some people argued we shouldn't have done anything and just let the bottom fall out and correct itself. That's a whole other debate. So Hoover's going to leave office, and then Franklin Roosevelt's going to come in. And Franklin Roosevelt is going to take a totally different approach. His approach is aggressive government involvement in the economy. He puts forward this plan called the New Deal. And the New Deal is going to include a whole series of new laws and government programs that are designed to try to pull America out of the Great Depression. I'm going to show you some examples of things that were formed during the New Deal that still exists today. So the legacy of the New Deal. One of the things that exists today that's a direct byproduct of the New Deal is something called the FDIC, which stands for Federal Deposit Insurance Corporation. If you go to a bank, you will see an FDIC sticker on the door when you walk in, and that's basically insurance for the deposits that you put in banks. I'll come back to that also a little bit more in a screencast later this week. During the New Deal, they created what is called the Security and Exchanges Commission, SEC. And what they do is they regulate the stock market. One of the things that happened in the 1920s that contributed to the rise in stock prices was that some companies were misrepresenting how profitable they were. And that the SEC is designed to prevent that kind of thing from happening. The National Labor Relations Board was formed during the New Deal. So this is a federal agency that protects employee rights. In the 1930s, as people were losing their jobs, there was an increase in sort of what is called labor activity, people trying to fight to protect workers' rights in the 1930s, and the NLRB was formed for that purpose. And probably the most famous of all the things created during the New Deal is Social Security. And that's something that still exists to this day. People across the country pay into a system called Social Security. And the idea is that when you retire, you get to get what is called a Social Security benefit or a Social Security payment that you will have until you die. There's a whole history of Social Security that we're not going to get into right now, but it is considered one of the most important legacies of the Roosevelt years, Franklin Roosevelt being given a lot of the credit for that. So what you have in the Great Depression years is a tale of two different presidents with two very different approaches to fighting what really is a monumentally bad economic condition. One of the questions that we may come back to is the question of how we survived the Great Depression. Actually, we'll come back to that in just a couple of weeks, because one of the things that is true, and I'll end on this point today, Franklin Roosevelt is often given the credit for pulling the United States out of the Great Depression. Not true. Roosevelt did not pull us out of the Great Depression. What pulled America out of the Great Depression was World War II. And that's something that we will be revisiting in the next couple of weeks.